Hello, everybody. Kirk Spano, Investing 2020s and elsewhere on the internet. Today, we are going to do a retirement income options program. We haven't done one, since before I was in Las Vegas, I think late May, actually. And I just wanted to walk through how we find our options to sell, what you should be thinking about, how you process the whole idea of selling a put for premium with the idea that you might end up owning that stock at the strike price. We'll also talk about selling covered calls, when you should do that. In general, when you have a big position that rises in price, you're generally just going to trim it if it gets overbought. Now, if it's in a choppy zone where it's going to go down for a little while and then go back up, you might try to game that by writing a covered call once the stock becomes overbought on the relative strength index, with the idea that, hey, there'll be some pullback. If it gets called away, you made some money. If it doesn't get called away, you collected some premium. A lot of times, if a stock starts to just really go parabolic on you, and you've already written a covered call, now you're going to have to scramble a little bit. Maybe you roll the covered call out and you sell a cash secured put to try to get back into the stock on some volatility. The reason I don't sell a lot of covered calls is because what I own, I really like. So I don't want it to get called away from me very often. You'll notice that I write 5 or 6 or 7 times more cash secured puts than I do covered calls. I would rather collect premium on my cash position with the idea that I might buy something than writing a covered call on stocks that I like and having them get called away from me when I really don't want them to get called away from me. So I'm very, very picky on both, but I'm more likely to write the cash secured put because that's money in my pocket today. I get to buy the dip tomorrow if there's a dip. And on the covered calls, it's really just position management with covered calls. The people who do the buy right strategy where they buy a stock and then they immediately sell a covered call, I've never really understood the point of that, even though one of my mentors loved that trade. I hated it because I could buy an Intel in 1997 or 98, and he would write a covered call because at the time he was handling the options, and the stock would go up $20, and we'd collect, $1 or $2 in premium and maybe get $1 or $2 in appreciation, but we'd miss $15 of upside. I specifically remember it happening with Intel and Microsoft. So I'm very careful to write covered calls because I just don't want my winners going away. We need to ride our winners and then cut our losers, before we lose everything. And that's, I think, the number one lesson of investing is that when you have a huge winner, when you have a company that's got everything going for it and the earnings keep up with the expectations, you generally should hold on to it until growth slows down. And then once growth slows down, and once earnings stop going up as fast, that's when you start losing classes of investors and the share price starts to bend the other way. If not down outright, the appreciation slows down, and then you need to measure the risk against that of the market. And anytime a stock has not any more upside than the broad market and a similar risk profile, there's no point in owning it. There's no point in having individual stock risk, right? Single stock risk. So if we're going to take single stock risk, we want big upside against the indexes and against most of the ETFs. So if we're going to own something, we generally want to own it quite a while, which is why we're not writing a lot of cash, which is why we're not writing a lot of covered calls. We want big winners. It's those big winners that set you apart from the index. So I'm going to show you TradingView, and we will go over a number of stocks, then a couple of ETFs. So we have looked at this screener before. I know there's new people out there. If you don't have something like this or this specifically, and I have a code for you to get a small discount if you want to buy this through your investment letter. But TradingView is, I think, the best software out there for doing this, mainly because they really treat the different time frames well. They give you ways of measuring different time frames so that you can figure out, okay, what is this doing in the long term, the intermediate term, and the short term? And while we don't trade much in the short term, the daily signals versus the longer signals of weekly or monthly can help us really get to within a few days of some of the lows on some of these stocks. We most recently did it with Spire Global, it looks like, and right before that, it was a Metis. So using technical indicators to help you find the right prices to buy is immensely important. I know that a lot of people don't want to learn it, which is why I've given you some shortcuts and a way to understand what Shooter and I are saying versus having to do it all yourself. And that's important. There's a lot of different things that I understand that I can read somebody else's work and understand it. And that will help me make decisions that are less emotional. So if I can take a look at Shooter's chart, and even though I'm pretty good with Elliott waves, I can't do what he does. I mean, he's like Neo in the Matrix. He just picks stuff out, and I'm like, man, I totally didn't see that. And I can understand it once he shows it to me. Would I be able to build that chart just like him? Probably not. I get lucky here and there. So what I want you to understand is that when we take a look at charts, there are different methods for doing it. Shooter uses Elliott wave along with basic technical signals that we all use. I like to use Wyckoff, which is where you've heard people talk about accumulation and distribution. That's what I'm into. I like to see the quantitative levels. I like to know where the super rich people in the institutions are buying things and selling things. And if I know where the big money is interested, I'm usually going to do pretty well buying alongside them. So let's take a look at this. Right now, NVIDIA on the weekly measurement, what does that mean? That means that every Friday when the market closes, you get a measurement. Now, you can measure any time period, monthly, weekly, daily, hourly, by the minute, but the daily is pretty much the standard. The reason I use the weekly as my starting point is because it shows me what stocks have been trending up for multiple weeks. Kind of that 4 to 8 week period is what is getting measured here the most. NVIDIA is one of the most overbought stocks, if not the most overbought stock in the market. Now, there might be some that are higher than this. I don't measure the entire market. I'm only tracking 274 companies, and that includes small and mid caps. But these are the companies that have caught my attention or are big enough or are growthy enough for whatever reason. Like General Electric, I just follow. I just like to see what it's doing because I've been following it for almost 30 years. If it ever starts acting weird in the technicals, that's a signal for me to go and take a look at the company. The technicals will pick up things in broad strokes that you may not be aware of. So when the technical indicators go wacky, take a look. Why is it going wacky? Oh, there's a short thesis. There's a bull thesis. There's a catalyst. There's earnings. There's M&A, right? So if you're watching the technical indicators, it's a reflection of what the market thinks about a company based on whatever the heck it is happening at that company. Sometimes those interpretations are right. Sometimes they're wrong. We make the most money when we can find a situation where the market is wrong and bet against the market. Other times we've been waiting for something to happen. The technical signals hint to us that it's either about to happen or happening because some money started to do something, and we can get in before the crowd, even though we may not have been first. Maybe we're second or third, but we're not 10 millionth. So getting in early is often indicated by what the charts and the technical indicators are doing, which is why we keep an eye on them. People ask me all the time, why did that price go up? Why did that price go down? I don't know. Go read the, stuff that's out there. Why? You should know why something's going to happen long before it happens. That's the whole point of being an investor, of doing it yourself. It's because you're going to take the time, say, okay, with a Metis, we're looking for these 7 or 8 catalysts over the next couple of years. Or this biotech, we expect this FDA approval, right? Or that satellite company, we expect them to get financing or not get financing, but maybe deploy a satellite that can get a cell phone signal to your telephone, right? You need to know what the catalysts are for the businesses that you invest in. If you don't, what the heck? Why are you investing your own money? Just hire me then. But if you're taking the time to invest, you've studied the corporate presentations, you know what they do, you've read up on the industry to see what the trends are, who's angling for what. Car industry is the easiest one to learn about. Okay, Elon Musk is doing this and this. Why is he doing it? Or Tesla cut a deal with Ford, GM, and Volkswagen on the Chargers. Or today, Ford lowered the price of the F-150 Lightning, which I told you was going to be the most popular truck in America, by $5,000 to $10,000, depending on the model and the trim. By the way, I've told you I have permission to buy that specific pickup truck. We're not a pickup truck family. We're probably not pickup truck people, but that pickup truck is so hot, so awesome, I kind of want one. I'm going to end up waiting for the Explorer that they just announced. But if I was going to get a pickup truck, if I was going to change to the dark side, that would be the one. So anyway, we take a look at these and we see, okay, some of these are really overvalued. Relative strength index. It means it's much stronger than the market over the last 14 weeks, because this is measuring a period of 14. It's not exactly how I do it, but this is the default. So 14 weeks, this has been stronger than everything else for 14 weeks. And what does that look like? Looks like this. So this is a daily chart. See, daily. I could change it to weekly. Looks a lot more extreme. But I have a way of measuring that I have down in here. These numbers in here reflect that setting. So I'm going to look at it on the daily since I want them to match. So this stock, since it bottomed in 2022 last time, has literally gone to the moon. What is up? 300%. If you flip back to the weekly, it really looks parabolic, right? Because these are weekly measurements, not daily. We can see with the relative strength index, it is really overbought, pretty much to the maximum that it's ever been overbought. Now, would I want to sell covered calls on NVIDIA? Maybe on a part of the position. However, because this is so overbought and my fundamental analysis says that, this might earn enough money in 5 to 10 years to justify this price, I'm probably just going to trim a big hunk of it. So if I own NVIDIA, I'm selling at least a third right here, and I might be selling 2/3. But if I only sold a third just because I can't get past my own emotions, maybe I write covered calls on another third. I don't think NVIDIA is worth $456. Everybody's screaming AI, AI, AI. Well, EIO to them. They're wrong. Why are they wrong? Because the growth rate for what's going on in AI is going to change to favor other players probably a year or two out, right? They're not going to be building AI forever, at least not at this pace. Eventually, there will be tools out there, AI tools, that we can all use for different industrial jobs, different personal things. And these AIs, remember, they're not like, pick your favorite movie AI. They don't know everything. They know what they're trained on. So if you are a steam fitter and you need an AI with an augmented reality headgear to go out into the field and do repairs in a tight spot that doesn't allow you to carry a book or go back and forth, right? You can wear some sort of visualization, and the AI will walk you through repairing this thing. And you can do that with any industry, jet engines, cars, whatever. That's the future of what AI is going to become in an industrial sense. In the office, it'll be right on your computer. Maybe you'll have goggles, who knows? But the AI is going to assist you in your task and just completely wiping out a huge hunk of time that you would have otherwise spent writing, editing, looking things up, flipping pages. You'll just say, hey, car AI, this thing and this thing don't work, but this thing and this thing do. And the car is doing this. What's most likely to be wrong? Boop, 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 boop. Oh, this is 90% likely to be what's wrong. And the other thing it could be is this, but it's probably not. So try this other thing first. Take this thing, connect it to that thing, flick this widget, plug that widget in, bam, fix. That's how it's going to work. So with NVIDIA, with that chart and those oversold, and with those overbought signals, an RSI way over 70, a chart that looks parabolic, that's chopped a couple times on the way up here, looks like it's chopping again. I think it's a good place to trim NVIDIA. Again, I told you I sold some before and after earnings. Smart thing to do. Could NVIDIA come all the way back down into the 100s? I doubt it. Like I said, I probably should raise my bottom fishing somewhere. Let's find out. Let's go back to 2018. You take a look at where the heavy buying was right there. Start to exhaust the selling, then you start getting heavy buying. So this heavy buying zone probably has moved up. You already had some there. So we can move our bottom fishing price up pretty far, but really any price close to 200 on NVIDIA, I think is probably back up the truck time. Now, am I going to end up moving this line up too at some point? We'll see. We'll see. Because time has a strange habit making big corrections. Saw one here, 320 to 120 or 330 to 110, 67% it dropped. Why can't that happen again? It can. That's the answer. Very easily could lose 300 bucks and go down here. You don't need COVID. COVID didn't barely move it. You have so many people pushing it up that when they take profits, then they cause fear. Fear leads to panic. Panic leads to anger. Anger leads to suffering. Suffering leads to the dark side, right? It's all about Star Wars. There's no reason it can't get back down here, especially as the AIs and this AI building boom subside, which it will, like every boom. I've looked at the fundamentals. I think that they're projecting out very aggressively 5 and 10 years, this price. On a valuation model, I think it should be worth around 300 bucks. But people love it right now. It's the hot girl. It's the cute guy. Everybody wants to date. But these signals here, this is how you tell, right? Because every time it gets up here, there's a correction. Every single time. There's no exceptions. None. Like this. Makes it a little easier to see. There you go. Look, don't the lines move pretty much the same? Every time it gets to here, there's a little correction. Now the magnitude is bigger, so it can hurt more. So trim your NVIDIA, write some covered calls. Go back here. Let's flip this over and look for things to try to get into. And in fact, let me make an exception and say, look, Rocket Lab on the weekly starting to get overbought. Actually, this must have just happened. It was 67 a while ago. But let's take a look at something here. Let's go out to a longer time period. Let's take a look at monthly. Let's find Rocket Lab. RKLB. Rocket Lab on the monthly is only 51. So why can it be 70 on the weekly measurement, but only 51 on the monthly? There's a logical answer. It hasn't been going up that long. Only been going up 4 to 8 weeks for the most part is how my measurements work and how these measurements work. But it hasn't been going up for months and months and months like NVIDIA was. So we take a look at NVIDIA, which has been going up about a year. It's overbought on the monthly and even more on the weekly. So Rocket Lab on the monthly, not so bad. Change it to weekly, 70. Change it to daily. Basically, what has it been doing in the last 2 weeks, right? So when we take a look at the chart for Rocket Lab, we set it to daily. Let's stretch it out a little bit. Okay. It's really just coming off of a long-term floor, right? Look, it crashed, moved sideways. Now it's just starting to move up. Let's look at this on the weekly. That seems to have an awful lot of potential, doesn't it? So the daily and the weekly are indicating there might be a small pullback into the 5s probably, right? Because you start to see huge pent-up demand down in this area. So usually, think about this psychologically, this price level moves up. People don't want to miss it again. So that's in the 5s somewhere. So Rocket Lab somewhere in the 5s probably bounces back up. Probably get some pretty neat Elliott wave charts on that. In fact, we have a couple. So with this one, even though it looks overbought in the short term, in the long term, clearly it's not, right? This is where it came from. And what do we know about the company from an execution standpoint? Well, a couple of neat things, actually. Virgin, which went bankrupt, Rocket Labs bought a bunch of their stuff out of bankruptcy. Talk about bargain basement stacking up. And they're getting some of the launch contracts, and they're just getting other contracts as the market shakes out for putting thousands more satellites in space. So this is one where you're not looking for a crash. You're looking for a small correction. You're not looking for a 67% down, which could happen with NVIDIA on horrible news. And I'm not projecting that NVIDIA will have horrible news, but horrible news could destroy that stock. Here, the horrible news has been baked in for a year. And now the catalysts and the good news are starting to manifest. So the likelihood of positive surprises from in here is greater than the likelihood of negative surprises when it was up here. So now good things are happening, and you expect it to chop its way higher. And then when it gets to near the all-time highs, the market will ask a question. Should it break out or should it break down? We'll figure that out when it gets up here. My guess, my very educated guess, is that it breaks out. And if SpaceX is getting valuations in the tens and tens of billions, this one should at least get a few billion more, right? So I would take a look at SpaceX, and I'd want to sell a cash secured put, even though in the short term it's overbought, because in the longer term, clearly it is not. This company is valued at only $3 billion. I think it's easily $10 billion and probably $15 billion company, as it secures a lot of business that other companies aren't going to be able to get to. Virgin, I mean, it's a huge competitor, gone. Say, okay, what cash secured puts can I sell? Given that I think it might pull back below 6 for a hot minute. Well, put this up there. You know, this is just a shortcut we use. You'll want to use your brokerage to get better measurements in real time. They say this is real time, but I've never thought that to be true. Say, okay, let's take a look at that puts that are out there. So October, a few months out, you want 50 cents for a $6 put. So for 3 months, you get a, what is that, about 9% rate of return for 3 months. If the bank came to you and said, we'll give you 9% every 3 months, would you do it? Heck yeah. Write this cash secured put. But make sure you also have a starter position. Well, maybe not today. Maybe you set a buy order at 650 just to buy the give back on whatever goes up today, right? Because we know that all these things chop along. So you're just trying to catch a little bit of chop on the downside if you don't already have a starter's position. I do. I have a 1% position in Rocket Labs. I've been selling puts on this one pretty frequently. They've been getting away from me, last several months. They just expire, but I keep collecting these 8, 9, 10% every few months. That's not a horrible consolation prize. So now let's go to our list and flip it over. What I was showing you there is an example of don't be married to these short-term time frames. You should already know a lot about a company. So you can say, hey, it's starting to rise in the short term, but I know that it got beat up for a year. What is the logical thing for you to think in that situation specifically? Short term is starting to go up. For last year, it got beat up. It's an inflection point. More likely than not, the market is telling you things are getting better, and people are starting to filter in. So now you flip this over and go, okay, what's oversold on the weekly? Oh, this is a daily chart. Let's look at the weekly. AT&T, which I got rid of a couple of weeks ago, not because I hate them. It's just because in growth portfolios where I had it, and dividend portfolios, I've decided, at least on the growth portfolios, unless AST Space Mobile works for them and they can figure out a way to monetize it, and they should, and unless their fiber really, takes off and they can start adding some more margin to their 5G, I think that the real catalyst for AT&T are 2 to 3 years out. Probably closer to 3, market will start talking about it in 2. While I'm cool with a 7% dividend, and if you're a retiree, you probably ought to just sit on it, because it does have backdoor growth down the road. They should someday start buying back shares, which will make the company even stronger. It's just such a slow road. And I should have recognized this a year ago, and I didn't. So that's on me, because damn thing drifted down from low 20s to 15 or whatever it's at now. I just think I can make that 30% back somewhere else better than I can make it back in AT&T. And that's a fundamental question I think you should always ask. I'm down on this one. What do most people say? Well, I'm just going to wait till it gets back to even. Screw it. Why? Everything is about relative performance. If you're only going to own up to 30 stocks, which is all you should own up to, is it one of the 30 stocks that I think I can make the most money in the next 3, 4, 5 years? I decided no. If you're a growth investor, you probably don't want it. You might come back in a couple of years. If you're a dividend investor and you just don't like to touch things very often, hold on to it. It's still a swell dividend. You could even sell cash secured puts. The problem is that AT&T doesn't have a very robust option market with much premium. I've never figured out why. So let's go down the list and say, oh, look, we're excited about Pfizer because of the mRNA platform. Right? We think that Pfizer over the long term is going to hit some home runs. And meanwhile, they have a bunch of stuff that everybody takes. So you take a look at them on the weekly chart. Okay, that's a good look, right? You see that it went up, chopped along, and now it's back down off of that initial COVID spike. Back to in the range where it was. So this price level acted as resistance here and kind of here, jitterbugged around it, and then finally broke out, then broke through it. This area around 35 has typically been a spot where you get really close to a reversal to the upside on Pfizer. It's happened twice. If you look at this as one big pattern, 1, 2, right, could see a big rally up. Some things go right for them and they have things on the agenda. So if I'm cool with a net price anywhere in this 35 range, I can go take a look at selling a cash secured put, take a look at my daily chart just to see how close we are to it being completely oversold. You say, well, it was down here and it looks like it's going to get a little bit close. So probably the next couple of days, you're probably going to get a chance to sell a cash secured put. So which one should you sell? Well, I like to go 2-3 months out. So here's 2 months out. $35 put, get you about 85 cents. So you pull up your handy dandy calculator and you go, okay, 0.85 divided by 35. I get 2.4% for 2 months. So times 6 to make it annualized. Would I be cool collecting an annualized 14% to maybe buy Pfizer if it gets below 35? Yeah, I think it would. But what if, nah, I want to get it cheaper. I don't want to buy this unless it gets down to, let's say 30. Well, now you have to set your good till cancel limit, say at $1 here, that would get you 3%, and hope the volatility gets the stock price low enough that it triggers at $1. I think both of these trades make a lot of sense. Sell the 35 for about 85, 90 cents. And if volatility pushes a little bit lower, sell another one at 30 for $1. So sometimes these two-steppers make a lot of sense. But I would just point your attention to this. Look at where the giant action is. It's at the $35 level. Somebody thinks that this is an important point. And if they're trading it to the bearish side, probably doesn't go much further down than here. It's kind of your maximum pain point. So maybe it does go to 30, but I would discount most of these. This is just people collecting nickels and dimes when they can. And they probably, right? The volume is almost nothing right now. So that means these all got sold a while ago, bought or sold. But what have I told you about cash secured puts? It is the most professional move you can make. Professionals sell cash secured puts nonstop because they sell them on their good ideas alongside of taking a starter position. And it's a way of basically having a good till cancel limit order that you get paid for. So when a stock like Pfizer comes down for you, now you sell your cash secured puts here because it's oversold near historical level, price level that makes sense, it has relevance. You start collecting premium with the idea, okay, I might sell a couple puts at different price points so that I can scale in slowly, small, and at wide price points, right? That's our mantra. Scale in small, slow, and at wide price points. In this case, 35 to 30 minus premiums is about 20%. None of this, I'm buying it because it's down 4% today. No, I don't want to buy stuff. I don't want to buy more stuff until it's down 20 or 30%. And at another price level, it makes sense to be a reversal. And it's another reason why I tell you it's okay to just wait and then start buying on the way up. That's called pyramiding. And that's okay too. Because whether you buy the left side of the bottom or the right side of the bottom, it's probably pretty similar. And if you buy the right side of a bottom, you're avoiding the potential to fall off a cliff. Now, I tend to buy both sides. So I'm, full of hubris trying to find these pivot points. Sometimes we get it perfect, like with the Metis, and it looks like Spire. But remember, our first buy on Spire was when it was $7. We've pretty much ignored it mostly since then. Sold a couple cash secured puts that we got assigned. My cost basis on Spire after the buys last week is under $1 now. Took 2 years to get there. You have to think very patiently with stocks because the madness of crowds can last a long time, bullish or bearish. Go back to TradingView, start scrolling down. If I was jonesing for Disney, I could look at it now. Paramount, I've got all I can eat, but you could sell a cash secured put here. On the monthly, I'll show you on the monthly, I bet Paramount is way lower on the monthly, right? Because it's just been getting the crap kicked out of it. So 38 on the monthly. That's about what it was on the weekly too, huh? Okay. What is it on the daily? Is it getting stronger or weaker? Yeah, they're all about the same. Paramount's probably in accumulate me land. So if you wanted to sell a cash secured put on Paramount, because it's chopping along at what appears to be a bottom, go ahead. But here's what you would want to know about that company that should influence how you think. Is if this writers and actors strike goes on past about September, then next year they're not going to have a whole lot of new releases for the theater, and they're not going to have a lot of new stuff for streaming, which means people being people, they'll cancel for 6 months and they'll wait for the next special. So I'm not expanding my positions in Warner Brothers and Paramount because I know that if this strike gets past September, that's a problem. But I'm watching that strike closely because if it looks like they're going to settle around Labor Day, plus or minus, it's probably a pretty big catalyst up. Then you probably round up your positions to whatever you want to get them to. So watch that strike. And if it looks like it's going to drag on, I don't really want to sell the positions. I might just have to resolve myself to holding them for a year as choppy money. That would be something I would sell a covered call on. I didn't think it was going to be too exciting for a year. I might even dip a little bit more. So when you buy and sell options, it's not just about the screening. It's about the company, what you know about it, how the catalysts and the potential pitfalls look on a calendar, and how you move your option dates, your expiration dates around those important things. So let's take a look at a Metis because this is the one that we've been working on lately. This is the daily chart. Just broke out past the level that was important. Could have gone down to this level. Doesn't look like it's going to happen. Kind of hit here and bounced off. Take a look at it on the weekly. I think I did that wrong. Take a look at a Metis on the weekly. See super volatility. Came all the way down here. And this is where we bottom ticked it. Right? We bought on the 5th and the 8th. You're just not going to do any better than that, right? But let's change it to a daily chart to figure out what we should be doing right now. Right? Different settings I use. Pretty good. You would expect some consolidation in here before the next leg up. Shooter and I think we agree that it's probably going to get a pretty good leg up. I think that by the end of the year, give or take, I think we're all the way back up in here. I think it's in the 20s by the end of the year. It's a heck of a rally. The time frame looks about right. How long it took over here, how long it would take over here. Remember, they have a whole bunch of catalysts lined up. So on Friday, I know a lot of people sold cash secured puts. I know that people sold some today at the open. If this stock keeps going up to reflect just its net asset value, right? If it triples, it's starting to sniff its net asset value. Value of its assets minus debt. Now, we can go back to Benjamin Graham and his net theory. Benjamin Graham, guy that trained Warren Buffett. I mean, anytime you can buy a company for less than the value of its assets and its cash minus debt, basically called a net, you're getting all kinds of stuff for free. So in the case of a Metis, assets net of debt are worth about $1.5 billion. They really have no cash to speak of, but the stock's trading at $300 million. Give some sort of a discount to that, say 30%, which is kind of typical, right? You always hear them talking about getting a 30% margin of safety. I think the stock can trade for around $1 billion by year end, which is where it's been in the past. That's why it was on the Russell 2000. Now it came off. But next year, let's suppose that the stock price is, somewhere between 1 and 2 billion. The Russell 2000 will act like a magnet in most cases because people will be excited about it getting added to the index. It becomes a self-perpetuating cycle, virtuous cycle. If this stock is over, I think it was 1.4 billion was the cutoff this year. Let's say the stock is at 1.5 billion in the spring. That means it probably is getting added to the Russell 2000, which means all kinds of more buying. So the 2.3 million shares or whatever it was, they got sold when the Russell 2000 rebalanced. Those would have to be bought again. And somebody already bought the shares that BlackRock and Russell, who else has a Russell 2000 fund? That's iShares, Russell, and someone else. So all the ETFs that follow that index sold, and most of those shares sold off market. Those shares didn't get dumped into the market during the trading day. Somebody agreed to buy them at the end of the day at whatever price it was trading at. And that's what they did. So somebody big, some institutions, bought all the shares of Metis up when they had to be kicked out of the Russell 2000 index funds because they weren't going to be in the Russell 2000 index anymore. So next year, there's a potential that 2 to 3 million shares have to be bought next June. Well, we know this company only has 34, 35 million shares outstanding, and then some warrants that'll push it close to 40, and some other warrants that are going to get issued. You say, wow, somebody might have to buy 5% of the float in one day. And the last time when they sold 5% of the float or 6% of the float, it didn't go down. This is a super bullish story. So I was in the chat rooms telling people, sell some puts and buy some stock on a Metas Thursday and Friday, because on a daily chart, it was time to do it. Because we know that we're very early for the long-term charts to start looking better. So the way that you use these time frames, combined with what you know about the fundamentals and the catalysts and whatnot, they all play together. It is important for you, if you're not using these charts, to at least try to use these charts. If you're never going to be able to do them yourselves, which is fine, at least look at these charts and think about the story that I'm trying to tell you, showing you the charts. It'll help you understand. It'll help you control your emotions. It'll get you asking questions. Granted, they'll probably be shitty questions to start, but that's okay. We'll get to the good questions. We'll get you from kindergarten to 4th grade to 8th grade through high school, college. And at some point, we'll get you where you need to be. Either a really advanced layman that can read it, or maybe some of you will take Shooter up on his offer to buy the software that he uses and let him mentor you. That's why he offered it. I've hinted that he needs a few people to mentor. Buy the software. Teresa, I'm buying it for you. She's not on today, actually. That's why she hasn't answered any questions. She is on what did she call it? She's in North Dakota. I don't know if she's looking for dinosaur bones or not, but she's driving around the Dakotas. Geological tour, I think she called it. But the software that Shooter uses, if you're over at Fundamental Trends and you really want to learn what he does, you should take that 15-20% discount that he negotiated and buy it, especially if you're trading. If you're trading, you should buy what he's using, because you've seen what he does with it, learn how to do it, and you might even end up with a job with me. So just want to show you CMEX. When this was down at $1, we talked about it. Is it a buy or is it going bankrupt? And because I didn't know the answer, we did nothing. But this is a company that I've watched, CMEX, and it rallied. Sure enough, it's up 700%. You win a few, you miss a few, right? But because we didn't know the answer of whether it was a buy or whether it was going bankrupt, we avoided it because we didn't know. And I don't think there was a way to know. We probably should have paid a little bit closer attention to when we were able to know, which was probably right here where the red line turned up. This curve is probably where it's headed. Probably going to test this local high at about 12. So if it pulls back, right, to under 7, and you have some interest in the cement market, you could take a look at it. Again, I don't think it makes my 30 stocks of places I think I can make the most money, but it was interesting, right? You're going to pass on a lot of these because you just don't know. Some of them are going to go up, but I bet for 10 stocks in this position, 3 of them go to 0. Do you want to take that chance? 1/3 going to 0 is actually statistically about right. No, you don't want to take that chance unless you know, or you 90% know. The last one of the stocks that we'll talk about, and then we'll go over a couple ETFs. New Fortress Energy. This is a daily chart. It's a weekly chart. I don't know that we see below this orange line again. If we do, it won't be by much. But what do you need to know about New Fortress Energy? Well, they just started producing natural gas from their first fast barge. Remember, these are the guys that can liquefy natural gas at sea. And they have like 6 or 7 more coming online this year and early next year. It's all going to be money dropped to the bottom line. If you've been paying attention to Bloomberg Green, you know that companies like Cummins and Plug and a bunch of others are ramping up electrolyzer production. What is that for? That's for green hydrogen. What's the other thing that New Fortress Energy is doing? They're building out hydrogen infrastructure because it's going to be used for energy storage and heavy transportation. Ships are going to go hydrogen, just like trains are starting to go hydrogen. There's one in California and one in Canada already using hydrogen on these fast trains. So between liquefied natural gas having a role in energy till the middle of the century sometime, and a big hunk of energy storage and heavy transportation going green hydrogen, this is a pretty good company with a long ramp. But because it's energy, it trades all over the place, and you're going to get your opportunities to buy it. Selling puts right now is a pretty good idea, and making sure that you have at least a starter position. I have a half position, about 2% in this company, and I am selling puts at $25 a couple months out, and I might just buy more stock because I think that the CEO of Wes Edens, who has a lot of his own money in this, take a look at the insider ownership, this area where it couldn't get past, I think the next time it does. I think the next time it blasts out of there. So for a bigger company, this is probably a pretty likely triple. And then he's been paying out variable dividends. I think at some point he does more buybacks and dividends. He's very creative on the financing, so we'll hope he doesn't screw up. I watch every deal, but they basically financed a dividend before because they knew that in a year they'd have more revenue. So there you go there. Over on this side, we started buying TLT a week and a half ago, and it immediately went up because we caught that little dip right there. I knew 1, 2, 3 that you're probably looking at a reversal in interest rates because inflation has come down, which we forecast way ahead of time about when it would happen. Gave it a 1-year range, and we're within that 1-year range. That inflation is not a perpetual problem because energy is getting cheaper. Aging demographics are what they are. People getting older. That's when they spend less. And we are at the very, very front end of healthcare deflation because of AI. So we're going to have full employment in this country a long time, and we're going to need 20 or 30 million immigrants to help take care of the boomers and do some of the labor jobs. Although more and more of those will be done by robots and smart machines. But we need more plumbers. We need more electricians. We need all kinds more skilled labor, people to build things. We need nurses. We need nurses' aides. We need homemakers. We need a whole bunch of people in here that are having babies. My daughter talks about having more kids. She's got 2 now. I think it would be a lot of work to have more than 2 kids. I had 2, and that was all I could handle. But all the people who really would like to have 3, 4, 5 kids, you know what? Elon Musk is right about this. It's not bad for us. Not with the current aging demographics. I mean, population curve all over the planet is bending over. So, if we can handle 9 to 10 billion people, which is where we're going to end up, and then maintain that probably works out. And in this country, we certainly are not short on space. Somebody's got their hand raised. Well, I'm not going to allow you to talk, but if you'd like to put a question in the Q&A or the chat, feel free. All right. So I think that this is going to break out because at some point they're going to lower interest rates. Buying this around 100, if interest rates go down a full point, because 20-year bonds probably pushes up about $20, 20%. That's how that works. It's not quite that perfect, but it's pretty close. So a price around 120, I think, is very likely. And if we have some sort of crisis, then the price probably goes way up here again on the combination of flight to safety and lower interest rates. Now, can this be a little lower for a while? It can. But just remember this one fact. We can't afford interest rates that are too high because of the national debt right now. Between now and the 2030s, which is when I'm forecasting that we start running a balanced budget and possibly surpluses, we have to finance our way to the peak baby boomer retirement pain, which is end of the decade. It's when they're all on retirement, at least Medicare, and we have to figure something out to keep them out of poverty because over half of boomers don't have over $1 million. And in fact, it's a much lower number. So over half of boomers basically have nothing but a paid-for house. So how do they retire? Part-time jobs and Social Security, right? Until they can't work the part-time job anymore. So we're going to figure that out. So with TLT, I think the easy trade is sell the $100 October cash secured puts for about $2. Making 2% for 3 months. Not super sexy, but remember it's bonds. And TLT is a hedge. So back in 2008, it spiked. All right, let's take a look at 2008. So here is what it did during the financial crisis. This is what it did during the QE era. Now we're in the QT era, and it's back down to this price level. Again, it can go lower. It can. It can get into the 80s. I don't think it will. It would take a resurgence in inflation for that to happen. But at around 100, look what I said. You got upside to about 120. Higher if there's a QE crisis, right? The other trade that we could do is based on volatility. Volatility is super low right now, right? Down at 13. The last time I made a volatility trade was 2018 when I was down here. Last time I made a successful volatility trade. I've done 2 other ones in here, and they both basically broke even. But this one was up like 600% because we used calls. I think starting to sell cash secured puts on volatility is an easy trade. So we use VXX to do that. Remember, VXX always goes down in the long run. So it's a trade. It's not a holding, but you can sell puts on it a month or two out. And if it gets put to you way down here, you can rest assured that it's probably going to get a spike in no short order. And the spike that I'm expecting that I thought in the third quarter would happen, maybe it doesn't happen until the fourth quarter. But those student loans are a big deal. You still have tens of millions of loans that are going to go back into repayment in October. So that could be a weight on the market. It could cause volatility to go up. And we have a VXX trade for that. So I'll put that in the article, but it's basically sell cash secured puts now. If VIX gets down to between 10 and 12, whenever the downward momentum ends, is we'll start buying calls quickly. That'll be something that we need the daily chart for, and maybe even a 4-hour chart. Because the people who made that trade with me in 2018, they got it right. They bottom ticked it. They made 6, 7, 800%. It's going to be hard to do that. But for a month or two, if we want to hedge, timing it to September and October seems to be the right thing to do. Worst case scenario, you collect some premium. Best case scenario, you pair it with a call trade at the right couple of days and you hit a home run. Then you take that cash and you buy some stuff that got cheap. So I'll spell that out for you in the retirement income options article today. It's already mostly done. On Thursday, we'll review the Global Trends ETF article because that is done. I'm just going to do one more edit on it. And we will have a section on trading QQQ every month. We will have an update on my 401k asset allocation every month, and then just a general asset allocation. So you're going to actually get a model portfolio, which I'm hugely against. But since I'm actually managing a 401k portfolio now, I'll show it to you. All right. Have a good day. I'll get this edited this afternoon after I eat, and look for the articles.